Welcome to the Australian Property Podcast. We're on a mission to become Australia's most trusted property podcast. We're very excited to be in the studio today with Amy Lunardi. How you doing?
I'm so good, Chris. Always good to see your face. We haven't done many episodes together for a little while, have we?
No, lots been going on. I mean, today's going to be a bit of an interesting episode. We're going to do the good, the bad, the ugly, things we've seen over the years, and just a bit of a banter on what we've seen and some of the horror stories, but also some of the success stories as well. But before we go there, Amy, what's been happening? Work, life. Yeah, what's been keeping you busy?
Work, life. Yeah, I feel like work is mostly my life at the moment because the Melbourne market, oh my gosh, it has picked up so much since the rate cut earlier this year. I think I actually timed it well going on maternity leave most of last year because the property market was quite dead and everything has just been reinvigorated. And really interestingly, a lot of investor activity. So my investor inquiry has gone through the roof and it has, it's not surprising considering Melbourne has been quite stagnant and all of a sudden it's, picked up a little bit, but it just kind of goes to show that when it comes to investing, sometimes looking into those markets, which perhaps are a bit slower, as long as the fundamentals are there, that is when you can get a bit of an edge. I know that we talk about not trying to time the market all the time, but also trying to sort of look into those markets that perhaps are a little bit sluggish and understanding why they're sluggish. And for Melbourne, it was because of interest rates primarily.
Yeah, and I guess the fear of the government, it had a tough time coming out of COVID, the return to work. There's, I feel like it's underperformed massively over the last decade. And that in itself isn't a reason to invest, but Melbourne itself is got very strong fundamentals. So these investors, are they people living in Melbourne or are they often living in different states?
I would say 80% of my investor inquiry at the moment is from interstate, interestingly.
Okay.
I've got a client too who I'm working with right now who's trying to buy in Mildura, an investment property. And I don't actually technically cover Mildura, but he just needed help with the negotiation phase. And he sent me a property. It had only been online for 2 days. And I called the agent and he said, this is selling today. I was like, oh, okay, no problem. He's like, yeah, I got 13 offers. It's like, oh, okay, interesting. And then I went and had a look at all of the properties currently for sale in Mildura. And basically every single one is under offer at the moment. Crazy. Really interesting.
Well, that's right, because they're going off the portal pretty quick. So unless new supply comes on, you could see that it gets even tighter. And it gives a lot of anxiety, right, when you see under offer as a buyer, because like, oh, go if I don't act fast, the next one could come off the market. Okay, so that's been keeping you busy. Lots of inquiry, and it makes sense. I think it's about time that Melbourne had its day in the sun. I think it's been unfortunately hasn't had the growth, I guess, places like Perth and Adelaide and Brisbane over the last few years, but. And I think it makes a lot of sense for a lot of people to be investing down there, even though the government has been a bit anti-investor over the last few years with particularly land tax is been a bit of a killer, but it's just one cost if you can factor into your overall budget. But what else? What other things in life have you been up to?
Oh, we've had a recent approval for a new development project, which I'm so excited about. So we previously did one. We sold it at the start of last year, and we learned a lot through that phase. Like, I am by no means a property developer. I'm like a beginner property developer. I really enjoy doing that on the side, but learned a lot from that project, which we now filter into this new project too. We actually ended up getting delayed with this one for various reasons, which I won't go into. Maybe Owen and I can do a podcast episode in the future about developing and things that we've learned throughout the process as well, if anyone's interested in getting a bit of insight into building and property developing, the good, the bad, the ugly around that. But hopefully we are starting building on that later this year.
Yeah, so it sounds like you're doing a duplex, like dual lock, or is it splitting a block in two, basically? Yeah,
one big block. So it's like over 800 square meters, chopping into two big 4-bedroom townhouses in the inner north of Melbourne. So that's where we live, and that's where I do a lot of work. Really familiar with that area, and currently working with the team at Build Her, who, if anyone listened to the podcast a couple of years ago, we had Rebecca on who talked about renovating and developing for profit, and they're helping us fine tune our plans and do our interiors as well. I'm really, I know what I like, Chris. I know what looks good and I know what sells, but to put all of that together, I just can't do it. I don't have that kind of creative talent to say, this joinery color looks good with this carpet and we should tweak this, we should tweak that. So I've surrounded myself with a really great team where I can still make decisions, but I'm not the one that has to put it all together. I don't know about you, Chris. You're a numbers person, aren't you?
Oh, look, I think there's so much, right? You can get obsessed, right, on taps and colors. And I mean, if you're going to live in it, great. But I think when you're developing, it's like, it probably doesn't matter as much. You go, what's outsourced to an expert, someone who knows this market, who's actually, why don't we go here, right? We weren't going to, but let's talk about some, in your experience, seeing clients, right, around dual locks or people doing townhouse developments or maybe even big renovation projects. Can you think of, maybe a case study where clients got that wrong or it was really, maybe not got the outcome they were hoping?
Oh, I've seen it plenty of times where developers have maybe chosen the wrong spot to do a development. Maybe they're trying to target higher end buyers in that suburb, but they've chosen the wrong street or the wrong area in that suburb, or they've built on a main road, which for a really high-end discerning buyer who has, if they're at the top of that market, the top of the bell curve in that buyer pool, they are going to be more fussy when it comes to location. And then sometimes I've seen developers to focus on just spending money on the wrong things with developing things that the buyers can't necessarily feel or see. They are added benefits. And this could be something like, extra energy efficiency ratings for, whatever the minimum is, or this really crazy fancy heating cooling system, which is awesome, but buyers aren't necessarily going to pay more. And then developers, they kind of want to get that return. They just need to make sure that that target market appreciates that. Sometimes it's better to then take that money and spend it more on better landscaping or better soft furnishings, which the buyers are, in many cases, going to be able to see and feel more and will add more of a direct value.
Yeah, I think this is what I've been guilty. I put my flag up here. I absolutely overcapitalized and maybe even undercapitalized in situations. And I think this is it where you maybe under renovate or over renovate and the market doesn't appreciate it. And it's very easy to push your budget out and think, oh, I'm going to spend $1 million. And then all of a sudden you start going, oh, maybe I should add this and add this and add this and this. And all of a sudden you basically just blown your profit because you spent, things that you're just not going to get the money back on. I've seen clients with, doing dual locks. I've seen clients do multiple, like 4 townhouse developments, etc. And while they've gone in there, they've bought the land, they've gone through the whole process, they've had to sell them all. Often they haven't really made any money on it. It's been really stressful. And if they just bought that land and held the land, it probably would have made just as much money, if not more money.
That's been very common over the last since building prices increased. That's been very common that developers have broken even or even lost money as well because they bought the land. And when you're developing, you buy land and you can only do your feasibility based on resales of that current day. You can't predict the future. And then it can take 1, 2, or 3 years to finalize that development. Things change so much in that time frame. There's a lot of risk there.
Exactly. And the buyers are always changing. You've really got to know what the local buyer really wants. I mean, it makes sense for you, Amy. I mean, the inner north so well. You know what the type of properties that go off like a frog in the sock, that whenever they hit the market, the buyers just love them. They're going to get 13 offers like that place in Mildura. And so I feel like you're developing the market. You're not, for example, doing a development in Mildura and going, oh, well, I can just do this anywhere. I think that's where a lot of people get it wrong, is that they apply what they like or what they think's good in their market, but maybe not what the local buyer really wants and will value. And I've seen people, they've gone one development, they've timed it really well. So they go, well, let's replicate this, and they do it again. And then the third one, they stuff up and they basically blow all the profit they've made on the last 2. And in saying that though, the dual lock, I've seen it go extremely well for clients when they've bought really well. A client did something down Thirroul in down near Wollongong. Bought the land cheap as chips pre-COVID. Built in COVID. Before the prices went up through the roof, and then basically sold it at the top of the market in when everyone was moving down there and no one could get houses. They made an enormous amount by doing a dual lock, and But those are, you have to time everything right. You have to time the land purchase, the sale, and do the build really well. And so, yeah, I think we've both seen where it works and where it doesn't work in that space.
Now, Chris, you and I can talk about random property stuff for hours together. But maybe let's revert back to the topic here for the purpose of the episode. We should definitely do a developing and building episode coming up soon, though, because I love it. I find it really fascinating. But property finance, all right, the good, the bad, and the ugly. We're going to start off. We've both got case studies, and I'm sure as a mortgage broker, Chris, you've got way more case studies than I do. But we're going to bring these up today as learning experiences to say these are some things that we've seen go right, some things go wrong, what you can learn from them. Maybe you listen and go, oh my gosh, I never thought about that before. But let's start off by talking about property finance and pre-approvals and what a pre-approval actually means, the different types, the risks involved, et cetera. Chris, if you can run us through just like a big high-level 101 about pre-approvals for getting finance to buy property.
Look, I think the issue with the good, bad, ugly, if we put it in that context, the ugly is when you get an automated sort of pre-approval through a bank. It hasn't validated anything. You might not even put the numbers in right. You might have put your gross income versus pre-super. You might have, said your cash was bigger than it was, etc. So just got to be really careful with any of those type of pre-approvals. And we have seen clients come to us and they've got one of those and they get declined or they can't borrow exactly what they need to, and then they are clutching at straws because they've already purchased a property and we have to sort of save them. And sometimes you can, and sometimes you have to, I have to ask family for money or something like that. So I've seen people absolutely stuff up their pre-approvals.
And the pre-approval you're talking about, Chris, so this is what's called maybe an indicative pre-approval, or it's just one that is not fully assessed by a human being. It's one which has basically, it's like a computer, right, that spits something out and it doesn't really thoroughly check everything, and it's not really worth anything. It's not giving you confidence that if you buy a property, they're going to approve your finance, right?
Yeah, look, more and more banks are moving down this way because it's quite a cost to get a human to look at it right, and then a lot of pre-approvals don't go ahead. And so, but if you've got any real complexity to your situation, you really just want to make sure that it's actually going to stack up and the bank's going to lend it, and they're not going to ask for all your pay slips and your documents and your business financials after you purchase. You really want the bank to get all those things up, check those. So when you do buy, really all they're going to do is check the valuation. And I mean, for a lot of people getting it wrong with finance, it's probably them just not being prepared prior to making offers. And then all of a sudden they're scrambling after they've made offers to try to make that property work. And I think that's where it goes really wrong for a lot of people.
So as a buyer, what's the best thing we can do? And what's the best type of pre-approval? How can we make sure that we have as much confidence with our pre-approval, our finance as possible before we're making offers or before we're going to auction? What do we need to be asking the broker or bank or doing in that process, Chris?
It's really just on your pre-approval. You should be able to see and know and ask your broker, what will I need to provide at settlement? And have I provided any of the docs up front, right? So that's probably the question you want to know. And it should say that on the pre-approval. Often the pre-approvals will just say that all we're going to do is get maybe an updated payslip because just to prove you're still working and to do a valuation on the property. But often a lot of other pre-approvals will say, yeah, this is indicative as long as all your docs match basically what you've said on the on your application. And so just be really careful and just make sure and check with your broker basically.
Sure. So the best kind of pre-approval is one that's been as assessed as possible. So fully assessed pre-approval, which is got as few conditions in there as possible, or conditions that you can definitely fulfill. For example, paying off a credit card or something like that.
Yeah, exactly.
And then it's always really important to understand, though, that pre-approvals are just pre-approvals. They are not a guarantee for finance. And even a pre-approval which is fully assessed and has, very few conditions, they will always be conditional upon a bank valuation. And a bank valuation is essentially to ensure that the bank valuer, the bank is happy with the price that you've paid, but also this type of security. We're going to talk about that a little bit later on because there are two elements there and you can get it wrong on both. There's risks on both fronts. And when it comes to finance too, we need to understand that if you buy a property and your finance isn't approved and you don't have any backup plans or you can't get finance elsewhere and you're not able to proceed with that property purchase, then you risk losing your deposit. And then further to that, you can also risk further legal recourse as well. So it's a lot. We are talking about risks that we don't want to take, or we absolutely want to make sure that if there are risks involved, we know what the worst case scenario is and we've got plans in place in case those worst case scenarios happen, right?
Yeah. So when we're doing checking someone's finance prior to doing major property moves, we do something called a loan scorecard in-house, and we just go through it. Is this low risk, medium risk, high risk? And most people are, medium or low risk, but then some clients will be like, oh, there's actually a high risk here because we've got to rely on, 1 year self-employed or 1 year bonus, or, your credit file is pretty, not great because you missed a few repayments. And so we have to look at, there's only a few lenders would lend to you. And if that lender said no, which they might do because they need to put an exception on file, then you're not going to get finance. And so you would never want to go and purchase a property if you're one of these high risk customers without having a bank sign off, because your alternatives are really small, and you might not be able to go to, private lending, etc. One of the big mistakes I think people make is, they assume the valuation, for example, off the plan. We see so many issues with finance. I've got a client at the moment, really having some major issues. They bought it off a plan a couple of years ago, probably against our advice, if in fairness, and those years have ticked by, and to settle on this property, they have to sell one property. Maybe they have missed a few payments on that mortgage, which they probably shouldn't have. They probably didn't save enough, and they're only just servicing. Servicing's changed a lot over the last couple of years. They've had a couple of changes of jobs, both people, and maybe 3 changes of jobs. And so they can service, but they have to sell at a certain price, and maybe they're not going to get us the price they want because they had strata issues. And so, what seemed to be an easy decision at the start, okay, let's sign this contract. In 2 years' time, we'll be able to settle, is actually quite complex for us to get this settled. They need to sell a property, and servicing is really tight. And now we've got some credit issues. And so off the plan, and then we don't even know the valuation yet of the property,
Yeah.
and
because the valuation for off the plan properties can't happen until essentially that property is almost ready to settle and the property's been built. So you have that large time period. Sometimes it's only a couple months away, but sometimes it can be several years away, where the market can change so much. And like you said, Chris, like these are high risk situations. Off the plan is probably where I've heard the most horror stories. Fortunately, not with my clients, and we almost never do off the plan, but I have heard so many stories where either that client's financial situation has changed, the lender's policy have changed, or that valuation has come in at less than what they've paid, and in which case they either need to go to another bank, try and get a better valuation, or cover that gap with a higher loan, or essentially chipping in extra cash. And a lot of people aren't in a position to do that, especially if this is like a 50 or 100 grand shortfall, which has absolutely happened before in off the plan situations, sometimes more.
Yeah, absolutely. So it's just that always you're never going to be sleeping at night comfortably, because markets can move. By the time you purchase sign a contract in 2022 and it finishes in 2025, a lot's happened in the world. And
yeah, your pre-approval back in 2022 is not going to be valid in 2025, everyone. It's about not going to be valid. It's not applicable. So you need to understand that risk. Actually, Chris, before we keep going into this episode, I think it's really important that we just explain conditional finance offers and situations versus unconditional for anyone listening to this that's new to the property world and hasn't heard of those words before. So you might hear this sometimes described as having an offer which is conditional upon finance or subject to finance. So when you're buying a property, that is the safest position that you can put yourself in if you are subject to finance. So what that means is that your offer will then only proceed if your finance is approved. And if your finance is rejected, then that allows you the opportunity to withdraw from the contract. So that's the safest position to be in. However, in many situations, you might not be able to be subject to finance. For example, if you're going to auction, you can't be subject to finance. Or if you're in a really competitive market you might not have the opportunity to be subject to finance because all the other offers are conditional, or sometimes the vendor might consider it, but you have to pay more than someone else if they're unconditional. So if you're in a position to not have a finance clause, it does give you a lot more options and it does strengthen your offer, especially in negotiations, especially if there's competition, but there is an element of risk involved. That being said, I would say that 90%, at least 80 to 90% of my clients, when we buy properties, we're not subject to finance because we have had really thorough conversations with the mortgage broker before we submit an offer to ensure that we are comfortable in proceeding, that we understand the risks, that the risks are low, and that we can have options in case of the absolute worst case scenario. And I've almost never had issues. I'm going to talk about a couple of issues later in the episode. But this is sort of stressing the importance to say you need to have a really great relationship and comfort with having these discussions with your mortgage broker before you do anything so that you understand what your options are and your risks.
Yeah, absolutely. So I think this is where a great broker, gets you humanly assessed, also looks at your situation and figures out if there is any major concerns. Like we know what's going to get approved by the banks. We're not just doing a mud on the wall approach and lodging it and being a bit slack with the paperwork. So you're just not ready and you've found a property and, or you picked a bank that could take 3 weeks to turn around a pre-approval and really you're in the market now and all of a sudden you're scrambling a bit. So a good broker will get you pre-approved, in with the right bank, fully assessed. So you're out there making ability to make offers. But the subject of financing, I find that, right now in Melbourne, good luck getting subject to finance on good assets because every seller's going to have multiple offers and some of those are going to be unconditional without having to wait for someone's finance to be approved. And so whenever you're buying a property at auction, that's unconditional. You can't then say, oh, sorry, my financing didn't get approved. They're not going to rerun the auction. So most good assets get sold, I would say, through some type of competition. And if you aren't confident that you're able to know that your pre-approval is going to stand up, then you can't really make an unconditional offer because you're taking too much of a risk. And so this is where a great broker is there to calm you and give you that confidence. You know what? The type of property you want to buy is fine. Your pre-approval is going to stack up. You've got the cash there. Go unconditional because you know that the finance isn't going to be any problems and the valuation of the property is not going to be any problems. Like I can't really even think of, 5 times out of 1,000 plus clients where we've had major valuation issues. Besides when you talk about off the plan, we've seen, many hands of valuation issues, even though we do very little of them.
Well, let's start with that. I was going to start with the good case studies, but let's end with the good case studies, Chris. Let's start with some not so good case studies or some, horror stories, etc. On that valuation one, because you and I have been doing this for a long time. Like you've said, you've seen very few valuation issues, and so have I. In the last over 12 years, I've had personally since I've had my business one, which I want to talk about in a minute, and then when I was working for previous companies, like maybe 3 or 4. But in all of those situations, we had backup plans and we had options because we had, had those discussions with clients beforehand. And in some of those situations, we thought there could be a risk because there weren't many comparable sales for those particular properties. But there was one in particular a couple of years ago where we purchased a townhouse and it was brand new and completely finished, but it was technically still off the plan because the plan of subdivision hadn't come through yet. It was pretty imminent. Next door, which was the identical mirror image property, had sold for high 1.3s. And the property we bought, we had a bit of competition and we paid 1.4. So the best comparable was high 1.3s, but because that property next door hadn't settled yet, the valuer wasn't able to then use it as a comparable sale because they are required to use, they've got parameters, and one of the parameters is they have to use settled sales. And all of the other settled sales in that area were completely different. They were much older properties, they were on main roads, so there weren't very good comparable sales. And the valuation for our property actually came back at 1.3. And we had this discussion before submitting an offer with this client, which I do for every single buyer, regardless of how risky their situation is, to say, okay, in the event that this happens, what are our options? And these clients had plenty of cash available to chip into that. It was not desirable. But that was really frustrating because later on, I think 6 months later, they just refinanced and they just valued it at a purchase price because next door was the same. But that was just one instance where we have these discussions beforehand so that we're prepared in case this happens, because the valuation is outside of our control. We do as much research as we can. And on the flip side, Chris, I've had plenty of situations where I've said to a client, look, I've valued this, I've appraised this as thoroughly as I can. However, there's very few comparable sales for this property. So there is a higher chance that this might come back, with a valuation shortfall. And in those situations, I've never had a problem. The valuer is certainly not out there to try and get you. They're there to try and make it stack up if they can. But this just highlights the importance. Before you put an offer in, before you do anything, say to the broker, in the unlikely but worst case scenario, if there is a bank valuation shortfall, what are our options? And the answers might be, look, we've got several banks we could go to. Let's go to another bank, get another valuation. Or we could tip in some extra cash. We could increase your LVR. There's other ways that we can work around this. You have to have those conversations up front.
Yeah, I think, you definitely, most people have got other options, right? Exactly. Just do another val with another bank. That comes in at fine. And I 100% agree with you. Most values are just literally rocking up. You sold it at 1.2. I think that's about fair, right? Take a few photos, next property, right? They get paid not much at all. So they're and they have to do a lot a day.
God, they've got so many a day to
Exactly.
do. They've got to punch through them.
Yeah. And it's not really interest. The bank doesn't really want low vals. The valuer, their boss doesn't really want to go low vals because you're going to argue it and it creates all this work. And so, but if you have got properties, we were thinking about a client buying something in the north of Sydney. It was like over 7 mil and a val came in on, mid sixes. It was quite a big drop and it really put the client, luckily the client had heaps of cash, but we had to argue this val and it was a really expensive val because it's a high end val. It's not like a $200 one the banks order. And so that was an issue. I had a client go a bit too hot at auction a few years ago. He even admits it. We ended up pulling out. What did we do in that situation? No, it was pre-auction. He went in too high. But he still had cooling off for 5 days.
Right.
So we ended up pulling out. So he had a 5-day cooling off. So he got lucky there because he just sold at his house and it was at the heat of 21. Trying to think about like too many.
There's a few others that like long time ago. I've only ever had one, which was at the previous company I worked at, with the auction valuation came in lower. And we actually argued that and had it amended. And it was an area in a suburb in the outer eastern part of Melbourne where there was this particular pocket of the suburb which was extremely desirable, always sold better, but had very few comparable sales. And we were able to get local agents to actually support, and like we got them to write letters to say, like, there's no comparables in this area, but every time properties come up, they're very highly priced. Here's case studies from years ago. We argued that one. And then we had another one which was a valuation shortfall, and the real estate agent who dealt with that valuer said to me, this guy is just always combative. Like, he just seems like he's out there to try and look for faults and problems. And we always have issues with him. I was like, oh my gosh. And we just went to another bank and the valuation was fine. So, it's very unlikely. I've had it happen so few times, but I always have the conversation just in case, because you never know. Now, valuations, it's not just about price, right, Chris? It is, well, first of all, about price, but then also to make sure that the bank is happy with the security. In other words, the type of property that you've purchased. I've got a couple of case studies here to go through, but have you had any issues, horror stories with securities, Chris?
Oh, yeah. Look, I think there's, sometimes people buy small apartments and they don't realize that not many banks want to lend on those. High density apartments where there's lots of them. Banks don't want to lend on those. Big farms, big acreages, things that, they look like resi, but they've also got commercial involved and, that type, like limited title, some people have never even heard of that, but, that's what sometimes they can be issues, corporate sort of owners corporations and sort of company title properties.
Yeah.
And so
company title properties, stratum properties, which we've got here in Victoria?
Look, it's not to say you can't get lending on them. It's just that, co-ops, there's just, if you get a property that's maybe, through your title search and looking at it, and maybe you just got to check. And maybe the bank that you pre-approved won't lend on that. They just don't want to get involved with that type of property.
Or
Often
they'll
there's,
require a higher deposit.
yeah, that's right. Exactly. They'll go, I only want high density where we've already got too much exposure to the building. Sometimes, banks say, well, I've already got 10 apartments in that block. I don't want to have any more in that block in case something goes wrong. And so, yeah, it's just always having a great broker there. It's just when you say, I'm really interested in this property, do you see any issues with it based on the bank that we're pre-approved with?
Yep.
They'll
So
say,
there's our little action point. Here's the thing. Here's the way that what we need to do is, if we're buying a property, touch base with the broker before you're going to auction or before you're putting in an offer to say, hey, I'm looking at this kind of property. I'm looking at this property. Any red flags here? Can I just make sure you're comfortable with this? Especially if you're buying apartments, and especially if you're buying in non-residential zoning as well. Anything that's quirky, anything that's not standard, that's a good way to frame it.
Yeah, and it's just, and the thing is, if you have issues getting finance on it, that to me is the red flag, because if you're having issues, other people are having issues, and a price of a property is based on who's able to buy it. And if lots of people can't buy that because they can't get finance, well, you can see that the capital value of that isn't going to go up as much as a property that anyone could buy with any deposit. And so just be really careful. Don't ignore these warning signs. If the banks don't want to lend on it, it's a good insight to say that, hey, maybe I shouldn't be buying it, is another thing to think through.
Yeah, and there's one horror story, which is fortunately not with any of my clients, but I'm just aware of it because it happened in the area that I live a little while ago, where a buyer bought a property. It looked like a house. It was advertised as a house. It was sold by a residential real estate agent, but it was commercial 2 zone. So there's various zones, across the nation, and segmentations within zones too, like commercial 1, commercial 2. And in commercial 2, you can't live there unless it's a caretaker's permit. It's quite complicated. But anyway, the bank said, no, we're not willing to lend you money on this property. I don't know whether it was they either required like a massive deposit or they just flat out said no. Regardless, that buyer had to rescind from that contract, and it ended up being a very costly legal battle for them after that because the vendor took legal action. So that is something which in your contract review, you should be, reading, and solicitors or conveyancers should be highlighting the zoning in their contract review. And if they're not, you need to be looking into that yourself. And then another situation, which is not a horror story at all, but was just a really good kind of example of when we're talking about smaller apartments. I was helping a client buy this really cute 1-bedroom apartment, and I took my laser measurer there and I measured that property. I measured it like 3 times. And every time it was coming up as like 39.8 square meters. And she needed 40 square meters for her loan. We made it subject to finance, and we ended up buying it because we just did not want to take the risk. And then when the valuer valued the property, they wrote that it was 43 square meters. And I was like, okay, well, I don't know how you got that measurement. I'm happy about it. But it just goes to show as well, like, don't rely on your own measurements with an apartment, because the valuer will measure it themselves, and it's sometimes going to be a bit different.
Yeah, that's right. And I think checking you've got a good pre-approval, check your property you're buying. I mean, another thing is you just got to be really careful that the terms that you sign up to are actually achievable. So I want to settle in 28 days. Well, is that really possible? That's relying on getting a second pay slip, or you've got to sell something or close down something. And all of a sudden, those days tick by really fast. We've also got to get bank pre-approved. We've got to sign loan docs, and just be really sure that the settlement terms is something that you can actually make happen. I've seen a lot of issues around this with upgraders. I can think of one at the moment where, they've gone and bought something before they've sold. They've said, look, we want 90-day settlement, which is probably a bit low. And then all of a sudden they've tried to sell their property, and the agent told them they could sell it really fast, and all of a sudden they can't. And you're in a really tight position there, because maybe you can't extend the settlement on the purchase. there's penalties, and that vendor might have already purchased something, or doesn't want to delay settlement. And then you've basically got to sell your place under a bit of fire sale conditions. And so be really careful, whatever you purchase, that you're actually going to be able to settle. You're going to have everything you need to be done for that settlement date.
Yeah, exactly. And also updating your broker if your financial situation changes at all. At all. I've got a really fresh case study. We went to put an offer in on a property the other day, and I spoke to the broker, and I got the clients to speak to the broker because we always double check every time we want to put an offer in on a property. And that all of a sudden they realized that they'd gone and got a novated lease for a car. And they were told from someone else random that that wouldn't affect their finance. And of course, it does affect their finance, or it has. And now we're in a position where we're not able to move forward with an offer on this particular property anymore because we're needing to sort that out first. So if you change jobs, or even within your company, you change positions, or you go and get a car lease, or you take on any debt, or whatever happens, please update your mortgage broker. Please update your lender to figure out if this is going to impact your loan at all. Always do this. Have you seen have you had any problems with this over the years, Chris?
Oh, absolutely. Taking out new credit cards, switching jobs, thinking that their bonus is going to be possible. Yeah, you're right. Like, absolutely changing your personal situation between when your pre-approvals, everything, that's what they're basically lending it on. Assuming everything stays the same, we'll lend you this money. But, when you do buy, a lot of banks will want to see your latest payslip. And so then it's like, oh, hang on a sec, I can't actually provide that because I just quit and it says that I'm, leaving. You can often get finance, if there's, new contract, new payslips coming, and, like sometimes we just got to work our magic to try to get exceptions on file and things like that. But anything that you're doing to change your personal situation, definitely run it through brokers, and most likely don't take out further lending. That's definitely a big risk often.
Yep, absolutely. And I think it's really important here to highlight too that you need to feel confident and comfortable with your broker. I've had several situations over the years where clients come to me and they say, I just don't feel like I'm getting the right advice. I don't feel like I can ask them questions. There's been a lot of mistakes they've made so far. And I just say that this is such a big thing that you're doing, that the risk is on you, not on the broker. You need to feel fully comfortable. I had one story from a few years ago which made me lose a lot of sleep, Chris, where the client was not comfortable with their broker. They had a pre-approval in place. I said to them, look, if you're not comfortable, I can recommend someone else. They said, no, it's fine. I just want to move on and buy a property. Of course, I had the conversation with this broker before we put an offer in to say, making sure we're completely fine to put an offer in, no issues with this finance, we're pre-approved, we're good to go. Yeah, it was totally fine. And anyway, it turned out that it wasn't a fully assessed pre-approval. It was an indicative, and this client was a casual contract. And the lender he went through didn't accept casual contracts at all. And the problem with this broker too is that he took so long to then say, like, this is a problem. And then he said, no, I can fix it. But by then we only had like 2 weeks to settle. And I lost sleep every night worried about this situation. And we didn't want to take the chance on this guy who had clearly not done the right thing at the very beginning. So I took it to another mortgage broker, which, oh my gosh, she saved the day. She managed to get us finance in such a short period of time. We weren't even a day late to settle. But, if you're not feeling confident, or if there's mistakes or problems, please just take that as maybe a sign to look elsewhere. Because this is a big thing. We don't want to take those risks.
Yeah, that's right. I mean, a lot of people want to use the broker that's a friend or a family member or a mate at the footy club or someone you knew from school, etc. And so I get that. And it's good to be supporting, people around you, people you care about, and so etc. But sometimes it's just where you go, oh, maybe this is just not the right person. I need to go someone who's a bit more experienced. And I guess even us as brokers, if I look at how I used to lodge loans in 2013, 14, 15 versus how we lodge loans today, great brokers just know what's going to get approved. They've got all the relationships with the BDMs and the credit teams, and they know how to sort of check before they lodge, because that's where you lose a lot of time is if, you lodge an application, just cross your fingers, mud on the wall approach, then it gets declined. A, that's not great for your credit file. And then B, you're scrambling. And then the file gets a bad smell about it. And it's like, well, why didn't that? Why are you coming 2 weeks before settlement? What's happening here? And particularly if it's something that's a little bit cagey. Whereas if it was packaged up the right way, the notes were the right way, it was checked with policy, it was checked with the BDM first, then it was lodged, the chance of getting approval is much better. And so I think that's just where the learning brokers, and that's okay. We all start somewhere versus say some more experienced brokers with bigger teams can and then we also potentially can get things settled a lot faster. Look, if there's favors that we need to call, we can call state managers and this is really urgent, settlements next week, and then they can escalate. And most BDMs have got like 500-600 brokers that they're calling them, and unfortunately, they can't escalate everyone's files, but there is a little bit of throwing your weight around here where you say, look, we're a big supporter of you, and we really need this deal assessed fast.
Yep.
And so great brokers absolutely can save the day, but it's not really a great situation when you're in that position. It's so stressful, right? Like,
so stressful, Chris.
Imagine potentially losing your deposit,
Yeah.
The other thing is I think with finance has gone wrong. It's not a finance thing. We had a client that actually ended up changing bank policy at a major bank where they got the loan approved. They were working with us. And in the background, their conveyancer, who wasn't our referral, was, one of their friends or one of their networks was being their conveyancer. And in the background, that conveyancer got hacked. And were hiding in the background. This is an over $2 million purchase. So it was a 20% deposit they had to pay. They already paid 5% for the deposit or 10%. I can't remember exactly what. But we're talking like it was about $600,000 or something. And a week before settlement, they got an email from the conveyancer to say, hey, transfer the money to this account for your shortfall. Because that's what used to happen back in the day. A lot of banks, you don't do that anymore. You just leave it in the bank offset account.
Yeah.
And that wasn't the solicitor's account. It was fraud.
Chris.
And
I've heard of this. There's a bunch of real estate most real estate agents now have policies that call and confirm over the phone before they do action anything. And we have in our emails and everything highlighted in yellow, please call the real estate agent before transferring any money for deposits. Please triple check everything because of this fraud. It's horrifying, isn't it? Now, just to round out the
good news is they got their money back, but they
that's good.
got on it fast. The banks, everyone jumped on it, and the bank happened to change their policy after that because it was a big case study because it's such a large amount. And so they got it, but you would never assume because I know that there's also cases where people don't get their money back, and so
well, just to round out this the negative part of the episode, which has been most of the episode. But just to round it out, because we talked about being subject to finance before as well and how that gives you a protection, but I'm going to put a little asterisk on this whole thing, because if you are subject to finance, first of all, you need to make sure that you do everything that you can to obtain that finance within appropriate time limit. I was reading about a court case recently in the news where a buyer didn't take reasonable steps to go and get their finance approved after they'd signed a contract subject to finance. And the vendor took them to court and the vendor won. Wow. So this is really important that you understand that you actually have to go try get your finance. You can't just sit back and be like, I don't want this property anymore. I'm just going to wait and let this lapse and say I couldn't get finance, or I'm just going to dilly-dally, or whatever it is. And then also another case study, which I was reading this really interesting book called Conveyancing 101 Question and Answers or something from Russell Cox. It's really fascinating. There was a case study in there where a buyer had put in a finance clause and they had put $400,000 or whatever it was in the finance, how much they were applying for, which you have to write into your clause. And they actually ended up applying for $420,000. So they applied for more than what they'd put in the finance clause. And then they got rejected. And then they actually got sued because they applied for more than what they put in the clause. And therefore, that wasn't allowed. And if they'd applied for $400,000, maybe they would have got approved. So you actually have to make sure that whatever you're putting in the contract is an accurate amount for the amount that you're going to go and apply for. You can apply for less, but not more. Just be aware of the risk there too. So whenever you're filling out a contract, speak to your broker first. Say, what do I need to write in this finance clause? For example, the lender, for example, the loan amount. Speak with your conveyancer if you're unsure. Please never just let the real estate agent fill things in for you. Please never guess. Please never assume. This is a legal document. Just get your team around you to give you advice on this, please.
Yeah, I think you just got to be really, to be honest, a lot of finance clauses are really hard for us as brokers, just being frank, because a lot of people say it got subject to finance and it's 5 days. And, it's really hard. It's actually really hard. Sometimes
5 days.
the banks are busy. And,
they get an evaluation done.
Yeah, that's right. And you've got to get new updated pay slips. You've got to get it and, get in the queue. And then the banks sometimes they do ask silly questions. And you get, a lot of the banks are struggling with this at the moment, inexperienced credit assessors who are just asking questions that are unnecessary. And you've got to then fight that and you go back in the queue and et cetera. And so also just be realistic. When you're asking to get in that finance clause, can I actually get finance approved in this period, or is it just not going to happen? And, we get stuck a little bit often when people are buying, properties in different states where it's very common, and we're trying to, run around to get finance approved, even though we know it's 99.9999% chance it's going to happen. It's just a waiting game because the bank's busy. And it's just a bit of a challenge.
If your finance clause is coming up for expiry, yes, you can request an extension to that. Please make sure you go through the solicitors or your conveyancer to do that. But if the vendor says no, your options are to then either go unconditional without full finance approval or to withdraw from the contract. Don't always just assume they're going to say yes to an extension. Don't go and negotiate a tight time frame, just assuming that they're going to give you more time. Now, Chris, let's wrap up the episode on some positive notes, which are generally less exciting and less interesting, because I would say, 99.9% of my clients anyway, it's just we buy a property, we've done all of our due diligence beforehand and as much preparation with finance as possible, and it's all fine. Everything goes through perfectly. Valuation comes back fine, no issues. So that's the good case studies, but I was thinking about a few particular wins that some of my clients have had recently with finance, and most of them, actually all of them, have been situations where they've either not known what their options were, or maybe they'd gone to a bank and been given a limited amount of options. I had one client recently who was pre-approved with one bank, and then I introduced him to a mortgage broker who ended up popping him into a first home buyer scheme, so the first home guarantee.
Yeah.
He ended up being in the same position in terms of what he wanted to spend on a property, but all of a sudden he was saving $20,000 on lender's mortgage insurance. That's a win. That is a big win.
Yeah, absolutely. I think there's lots of ways that, success stories where it all goes fine, and most of the situations are like that. And I think you just want to have a good person on your side just to really weigh up all your different options for you, and not just facilitate and validate what you think you want to do, really challenge you. And sometimes it's the small things, like you said, even if you go to one lender versus another lender on LMI, that can make thousands of dollars of difference in your pocket that, some brokers might not just pick up on. So
easiest money you'll ever save there. Yeah.
Thanks so much, Amy. I look forward to our next chat, and thanks everyone for listening.
Thanks, Chris. Catch you next time.
Thanks for watching this video on the Rask Network. While you're here, don't forget to like and subscribe so you can get videos each and every day on business, finance, investing, and so much more.